I'm here at Davos with Anthony Scaramucci, founder and CEO of Skybridge Capital. It has been an epic start to 2016. Markets are off across the board. What has changed, Anthony? What has changed in the last several weeks to make investors shift their sentiment so much?
Just remember that subtle changes can make a big difference to markets. And so the big thematic change is the Fed is embarking upon interest rate normalization. Secondary change is that you've got a glut of oil, way more than people had expected. And so the confluence of those two things have unsettled the markets. But I think the deeper thing that's going on, Charles, is that the markets are now just resetting back to more historical norms pursuant to where the Federal Reserve is likely to be by, say, the beginning of 2018. And so that means a 15 multiple on stocks. It means a little wider spreads as it relates to high yield, wider spreads for the emerging markets. And you're seeing that manifest itself. And we both know, because unfortunately for me particularly, I've been around a long time, markets have a tendency to oversell or overbuy situations. And so we could be getting extended here at some point.
And they seem to be doing it all at once. It seems like everything is happening all at the same time.
Well, don't forget, in the last 10 years, you've gotten a lot faster on the foot as it relates to electronic trading, bond trading, commodity trading, and so the reaction time is going to be a lot faster going forward.
Now, a lot of what's happening has been attributed to China, problems with the Chinese economy, big meltdown in the Shanghai Composite. To what extent is China a prime mover here, and to what extent is it really a reflection of some of these other forces that are happening in the rest of the world?
Okay, so us at Skybridge believe that is a short-term phenomenon for markets, meaning it's a reason to find to sell, but it's not necessarily the economic fundamental reason. You know, if you look at our exports into China, they're not high. It was a 3-4%. It's not that significant of an impact on the U.S. economy. And so China, while it's worrisome from a hard landing or soft landing perspective, our view is that the policymakers there have enough tools in their kit, they have enough currency reserves to get the thing right long term. I think the bigger issue is the macro issue of the Federal Reserve. And where will the Federal Reserve be over the next 24 months as they raise interest rates? Typically, they've gone 250 basis points from start to finish. And so if they got there, or let's say it takes them 3 years to get there, it would imply a 15 multiple on stocks. And you and I both know that the earnings that are coming in are a little shaky. They're off roughly 5% from where the expectations were. And that confluence of events is bringing markets lower.
Do you think, given,
it's not a super crisis.
Given how much pain there was or clamor there was around a 25 basis point rise, getting up to 250 basis points is going to be, it's going to cause some people, plenty of disruption.
Okay, and I'm not necessarily disagreeing with that, but I do think over time the market will start to condition for normal rates. If you and I were sitting here 10 years ago and we said that the overnight rate was 150 or 250, we'd say, okay, that's a pretty benign interest rate environment. And so it's just the fact that we're working off of zero that's been so seismic for people as they make this adjustment.
Let's talk about oil. Last thing I want to discuss. So oil is, I think, surprised pretty much everybody that we went down so fast, and so far it's still falling today. It seems like oil is reflecting some pretty big secular shifts in supply and demand. Where do you see it? Do you see that continuing for a long time? And what are the consequences of that? How does it remake the geopolitical landscape? How does that remake the investment landscape?
You see, I think this fits into our theory that things get overextended. And so what I was saying earlier is that the United States has monetary policy and the Saudis have oil-tary policy. Okay, they've made a decision to pump up the supply. They put $1 trillion gamble on in the markets by increasing all that production to try to regain oil share relative to the other countries. That puts a hurt on Iran, who they're arch enemies with. Puts a hurt on Vladimir Putin, who's been helping Syria, who they're super upset with. And it's also knocking down the E&P producers in the United States. I don't think anybody, including them, anticipated that prices would be where they are now, and that's always the overreaction in markets. And so I'm super worried about that. If you ask me of all the black swan events that could take place, the fact that oil prices are where they are today, I think you have to be worried about further instability in the Middle East.